Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Welcome to another one of these quick market updates and a topic today that I think is going to help a lot of you answer the question, what should I invest in right now? And one of the most common questions I'm seeing from beginner investors and experienced alike is what the hell is up with this market? We've got the most people out of work in history, more than 20 million people. Companies are reporting a 60 and 70% drop in earnings. And yet the stock market is off its February all-time highs by just about 10%. So the stock market bottomed on March 23rd, and despite more than 30 million Americans filing for unemployment since then, stocks have rebounded over 30%. So what I want to do in this video is show you why the stock market is so disconnected from reality, so disconnected from the economy, give you a roadmap for where stocks go for the rest of 2020, and then 3 scenarios for how to invest right now. Now, first, understand that the stock market is a forward-looking market. Investors say that the market prices in the foreseeable future over the next 6 months or longer. And what this means is that you have millions of investors poring over economic reports, monetary policy, which is things like stimulus money and the outlook on corporate earnings, and they come to a general agreement through stock prices on how the company profits are going to come out in 6 months' time. Of course, they're not always right. The market tends to be optimistic. So you have times like now when 1 in 5 people are unemployed, but investors are looking out towards the end of the year and even into next year and saying they believe company earnings are going to be on the way to rebounding. So right now, investors are looking at nearly $3 trillion in money being pumped into the system through those bailouts, stimulus checks, even forgivable loans. Besides the government stimulus, we've also got the Federal Reserve, so the central bank is just shoveling money into the economy. It's not just the US here either, but all the money pouring into the global economy for stimulus. Now, the government and the central bank has basically said that they're willing to do whatever it takes to keep the economy from falling any further. I mean, the Fed has gone so far that it's going to start buying the debt of junk-rated companies. Now, think about the message that sends. The US central bank, the creator of our monetary policy, they're going to invest in companies with finances that are so screwed up, they're rated junk or non-investment grade by those rating agencies. So investors see a government that's willing to throw the old rules of monetary policy out the window and just print as much money as it needs, whether it's printing 3 trillion or 30 trillion this year. Now, the market's also looking at states loosening those stay-at-home orders, and this is where it gets a little gruesome. Yes, those daily cases have gone down, but with the end of the lockdown, we're likely to see those jump again. Of the 5 forecast models here, we're looking at between 106,000 to as high as 165,000 coronavirus deaths by mid-June. But the stock market is betting that people just don't care, that they're so fed up with being locked down and that people would rather sacrifice those 100,000 plus lives to get back to some kind of normal. So the market's saying, yes, we could get another spike, but it's not going to lead to that same kind of business shutting down scenario. So that's why the market is higher, even as the economy looks so bad, and we could get that second wave of infections. But I also want to warn you that everything might not be as rosy as it seems when we look at the market. So if we look at the stock market by sectors, yes, we see the overall market, that's the S&P 500, is only down by about 10% from the beginning of the year. But look at the difference in some of these sectors of the economy and the stocks within each. Yeah, you've got a few sectors like healthcare and communication services that are doing really well, and tech stocks are actually positive on the year. But you've got other sectors like energy stocks that are down 35%, and I'd say the most telling here is financials and industrials, 2 very cyclical sectors that follow the economy closely. These are both down more than 22% on the year. And now the reason why the overall market, the S&P 500, looks so healthy, and this is what a lot of investors are missing, is because how big some of those sectors are in the market. Information technology itself, those tech stocks are up over 3% on the year and make up more than 25% of the stock market. Now you see the stock market, the S&P 500 index is put together with the 500 largest companies by market size. So if you get a few big tech names like Apple, Google, and Microsoft that are trillion-dollar companies, that pretty much dominates the entire market index. So you've got just these top 3 sectors, tech, healthcare, and communication services, that make up more than half the S&P 500, and all 3 are down less than 3%. So yeah, the market looks rosy even though you've got some other parts of the economy that are down 20 and 30% on the year. So now just understand that when someone says the stock market crash is over, it's not necessarily over for every part of the economy, just for those big giant companies that everyone pays attention to. So that's where the stock market is. Now where will stocks go for the rest of 2020, and how can you use this to decide how to invest for the rest of the year? One of the measures I've been following through all of this has been the forward price to earnings ratio, and just like the market, it's absolutely crazy. The S&P 500 index, after that 30% run, is now trading at a price more than 20 times the earnings analysts expect companies to report over the next year. That's a high we haven't seen since 2002 and way over the average of around 16 times earnings. So again, you see that giddy optimism of investors, thinking everything is going to be all right despite the fact that earnings are likely going to be really weak even into the next year. The fact that stocks are already expensive though on that PE ratio means there probably isn't going to be much upside to the rest of the year. And basically you need one of two things for stocks to go higher here. First is if investors don't mind paying a higher ratio or higher PE value for those lower earnings. But we see that the PE ratio is already about as high as it's been for the last 2 decades. Even if we tap that high point we saw in 2000, around 23 times earnings, that's still only a 12% higher return from here. Or conversely, companies need to start reporting higher earnings, and we know that's not going to happen for at least a quarter or two. Most companies actually withdrew their outlook last quarter, saying they didn't know how bad earnings were going to get for the rest of 2020, so they're just going to stop trying to estimate. That's not an optimistic scenario. So I'm thinking that the stock market as a whole, that S&P 500 index is probably going to have a hard time making it above 3,000 for the rest of the year. Again, though, this picture is slightly different if you look at some of these individual sectors. Here we see each sector, the current forward PE ratio in blue against a 20-year average PE ratio in gray. And some stocks are ridiculously expensive, like consumer discretionary, industrials, and the stocks of materials companies. But you've also got those sectors like healthcare trading much closer to that long-term PE average. Against a broader market that's 32% overvalued, healthcare trades for less than 1% above that long-term PE ratio, and stocks in the financial sector are trading for just about 10% over the average. Now, of course, against all this, we also have 3 major market risks this year that could bring on that next stock market crash. The first is a big risk around July and August when companies actually do start reporting their earnings for that April through June quarter. Now, these are going to be historically bad, and everyone's planning on it, but I think just how bad is going to surprise everyone, including Wall Street. Nation, just 32 companies in the S&P 500. That's 32 out of 500 companies have provided guidance estimates on their second quarter earnings. And when I was an analyst, these estimates from management were critical in just being able to forecast not just the earnings for that company, but for the entire industry and the market. Now, with most companies saying that they have no idea what earnings are going to be, you're going to have a lot of big surprises coming July. And for the first time, we're going to see just how bad this thing is for investors. Now, the other 2 market risks could hit right around the same time, around October and November. It's here when that seasonal flu season usually starts, so any slight increase in the coronavirus cases could really spook the market into thinking we get another second outbreak of this thing. Also, in that late September, early November period, we've got just a little thing called an election going on. And we actually did a video on this last Friday, so I'm not going to repeat it here. But in that video, I showed you a stock market signal that's pointing to just how dangerous this election could be for stocks. I'll leave the link in the video description below, so make sure you check that out. Now, with all these risks and as expensive as stocks are right now, the best case scenario is probably for stocks to be maybe 5% higher by the end of the year, but more likely range bound and even most likely probably down 10 to 15% at any one point. Now, as for how you should invest right now, I want to give you 3 scenarios and 3 ideas for how to invest. And for these 3 scenarios, I want to call these after popular letter names so I can explain what those are as well, because I've gotten a lot of questions on that lately. Our first scenario is a V-shaped recovery, and this is when the economy drops fast but then rebounds quickly. So we already know that earnings for the first and second quarter are going to be down like 14 and then 40%. But then if those corporate earnings rebound strongly, like 20 and 30%, maybe in the fourth quarter and then the first quarter of next year, that would be like a V-shaped recovery. And if this is your outlook, then you want to start investing in some of those hardest hit sectors, those hardest hit stocks. Now, understand here, I'm not talking about those very hardest hits like the hotels, the cruises, and the airlines. And I want to address this also because daily somebody asks me if they can jump into United Airlines or Norwegian Cruise Lines. Yes, as the reasoning goes for these, we will always have airlines and people are always going to be flying. But that doesn't mean that all these companies are going to survive over the next few months. Don't forget, every major U.S. airline has filed bankruptcy in the past. That's including United, Delta, and American. When they did that, investors got totally wiped out, even if the company eventually emerged to issue new stock. So I'm not saying jump into these companies with those horrible balance sheets and the bankruptcy risk. What I am saying here is that you can look at some of these other stocks like Automatic Data Processing, ticker ADP, which is down 20% this year, but a really solid company. Or one of the few banks I like, M&T Bank, ticker MTB, which is down 42% and trading for less than the book value of assets. There are still great deals in individual stocks if you do a little analysis and look for that survivability. And these companies are going to be a good long-term bets even if the economy doesn't bounce back quickly. Now, our next scenario is the U-shaped recovery, where the economy falls quickly, stagnates for a little while at the bottom, and then bounces back. Now, this is where a lot of analysts are coming up right now that their previously rosy V-shaped bets just aren't looking too likely. But since the stock market is still holding out hope for that quick recovery, this is where you want to protect some of those recent gains. Now, this is where I'm at with most of my portfolio. I'm doing 3 things to invest in this market. First, I've sold off some of the stocks that I bought at that market bottom in late March. Those of you in the nation will remember I had 45% of my money in cash and bonds going into this in late February and a strategy for how I was going to use it. I invested 25% of my cash when the market hit 15% down and another 35% when it reached 25% down from the peak. Finally, I put in the rest of my cash and some of the money from selling bonds when the market hit 35% down from its February peak. So I made some really strong gains in some of these stocks, but I've taken the profits because they're just not that great of value of when I bought them in late March. Now, I've used some of that cash and the money I've deposited over the last month to buy back into some of those bond funds. I've also sold call options, a covered call strategy on the stocks that I'm still holding. This is a strategy I detailed in a previous video, so I'll link to that in the video description below. Basically, you're selling someone else the right to buy those shares off you in the future at a set price and then collecting a payment now. If the shares don't reach that contract price by the expiration of the option, which if the market runs into trouble, they won't, then I get to keep the stock and the money paid for that option. So I'm back up to about 20% of my portfolio in cash and maybe another 10 to 15% in bonds. I'll hold on to this and look to put it back into stocks around November or December, or if the market falls hard and the opportunities come up. Our third scenario here is what the market is calling an L-shaped recovery, and this is the scary one. This is when you have that hard drop in the economy like we've seen, but then the rebound is more of a slightly sloping line, as if the L was tilted a little bit. In this scenario, which isn't altogether out of the question, it takes longer than expected to get those 20 and 30 million people back to work. And the economy just doesn't jump higher, even with all that stimulus spending. And this is what would probably happen if inflation started kicking higher and the Fed had to start raising rates earlier to fight that. In this scenario, you want to be protecting your recent stock gains, just like we did in the last one. You're going to be wanting to keep some money in cash and bonds, but you're also going to want to look for some of those safety sectors that you can hold up in for a while. This is probably good for a low single-digit return, so at least a return to beat inflation for that little extra bit, but without the risks that we're going to see in those really expensive sectors that are probably going to fall hard when the market sees we're not getting that V-shaped or the U-shaped recovery. So here I'm thinking investing in sectors like healthcare, utilities, and telecom, which should all see fairly stable revenue even in a prolonged recession. Click on the video to the right for which stock sectors could rebound fast and how to invest your money in any economy, which stocks are ready to run. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.